Term insurance. Term insurance is the simplest and most affordable form of protection plan. Key features of term insurance. The benefit of term insurance is paid out when an insured event occurs. It usually costs less than whole life insurance and endowment insurance policies for the same level of coverage. There is no savings or investment feature in term insurance. There is no cash value when the policy ends or is terminated prematurely. Fixed or level term insurance may range from 5 to 40 years. The coverage remains the same throughout. Decreasing term insurance. The coverage will reduce over the years and become zero by the end of the term. This is commonly used to cover housing loans. It may have convertibility and renewability features. When considering term insurance, choose the term you want carefully. If you choose too short a period, your dependents will have no coverage to benefit from after the term expires. If you want to buy another term insurance policy after the first one has expired, you will be subject to medical examination. The premiums will also cost more due to increased age. So it is increasingly costly to purchase term insurance policies over time. Consider buying a term insurance product for a longer period of coverage when you are younger. Do pay premiums on time. If a policy lapses, a reinstatement of policy will require you to prove that you are still healthy. Whole life insurance. Whole life insurance provides you with lifelong protection. Key features of whole life insurance. It pays out the death benefit upon the death of the insured. It is more costly than term plans with the same level of coverage. Cash values will build up after a minimum period, usually after 3 years. Premiums are fixed at the point of purchase and will not increase over the years. Riders may be attached to the policies. Riders are add-ons to enhance the benefits of the policy, such as including the coverage for critical illnesses. This will require additional premium to be paid, and premium of some riders may increase with age. Participative and non-participative whole life insurance. Participative policies shares in the profits of the company's life fund. Your share of profit is paid in the form of bonus or dividend. Bonuses or dividends are projected and hence not guaranteed. A non-participative policy is not entitled to any profits the life fund may make. Loans can be taken from the cash value. The insurer will charge an interest of between 5 to 8% on the loan. Premiums are payable over a lifetime or a limited period, depending on the type of whole life product. When considering whole life insurance, given that buying a life insurance policy is a long-term commitment, consider the amount of premium you are able to commit, as early termination may result in losses. Endowment insurance. Endowment insurance policies are often marketed to help you meet financial goals like paying for your children's education or building up savings over a fixed policy term. Key features of endowment insurance. It pays out the death benefit upon the death of the insured. It usually matures after a fixed period of time, for example 10, 15 or 20 years. Participative or non-participative endowment insurance. Bonuses or dividends projected by participative plans are not guaranteed. The cash value will build up after a minimum period, usually after 3 years. Loan can be taken from the cash value. The insurer will charge an interest of between 5 to 8% on the loan. It is more costly than term and whole life insurance given the same amount of sum assured. The sum assured is paid out when an insured event occurs. When considering endowment insurance, compare the features, returns and risks of the product against those in the market. Buy one that can meet your needs and that you are able to sustain payment in the long term, as terminating the plan before the maturity date will result in losses. Annuities. An annuity is a type of insurance policy which guarantees fixed payments at regular intervals, usually monthly, for as long as the policyholder lives or for a fixed period of time. Key features of annuities. They are usually purchased to provide for retirement income. Premium is usually payable as a lump sum, but there can also be regular premium payments for an agreed time period. CPF Life is an example of an annuity. When considering annuities, consider the financial strength and soundness of the insurance company and the returns it has paid out in the past. This serves as a guide, but do note that past performance may not indicate future performance. An annuity is an instrument that is usually used to hedge against longevity.